Let's talk with Liz Ann Sonders. Joining us, the Chief Investment Strategist, Charles Schwab, with us here this morning. Liz Ann, great to have you back. Good to see you.
Good morning. How are you?
Pretty good. Coming off all-time highs, of course. So the bullish vibes are back. What do you think, Liz Ann?
Yeah, I think it's not so much bad news as good news, but less good news has been good news. You've had some easing in economic data, obviously the jobs report being paramount among them, weaker retail sales yesterday, particularly the control group, which is the feeder into GDP. You know, PPI on the surface was seen as a little bit hotter, but it was only hot in month-to-month terms because we had big revisions down to the prior month. You had a relatively benign CPI report. So that continues to support the notion that even if the Fed isn't imminently set to start easing policy, the need to pivot back to rate hikes, I think, has been tabled for now.
Okay. And that potential for hikes, you think, was behind the kind of April scare there, Liz Ann, as getting that out of our system, kind of easing, I guess, this market in a way?
I think the concern about hikes was driven by 3 months in a row of hotter inflation readings, particularly within the CPI, but also that employment cost index report that really popped higher. And then I think you started to see an easing of some of those concerns when you had a still decent but slightly worse than expected jobs report and then the inflation data this week. So I think rightly so. I don't think the Fed's bias was to shift toward a tightening position, but that the data there pointed to the possibility that they might have to consider that. And again, I think that's off the table for now. I think pause mode is where we sit for the near term.
If I can kind of pose this next question through the dollar, Liz Ann, because I feel that that's kind of a good way to think about the expectations of hikes versus cuts and the fact that in the near term it seems like we're kind of going to be doing neither. And the dollar has often been not necessarily inversely related with stocks, but when you get these big dollar upside moves, they usually happen while risk assets are coming under pressure. Like, how far can that dollar go down? Which I guess is kind of a way of asking how far can stocks go up in some sense if the rest of the world is just on a different path. Like, how far can that dollar go down, you know, if we're not going to hike, but we're not cutting either?
Right, probably not very far, because the underlying fundamental that is most highly correlated to moves in the dollar, of course, is interest rate differential around the world. And even if we are not positioned to move back to hiking policy, just staying in pause mode amid an environment where the other central banks either already have or are kind of eyeing the exits from tighter policy and looking to ease policy, all else equal, that is supportive of the dollar. Obviously, the other impact in terms of moves in the dollar come in the trade relationship and the weaker dollar being beneficial to U.S. exports, which has been one of the negative contributors to GDP. So I think of both the drivers of dollar moves and then dollar moves and the impact that has on things like the trade relationship, as well as the high percentage of sales in an index like the S&P that come from foreign sources.
Okay. Do you think that investors should be celebrating the recent data as, the stock market breaking out here, Liz Ann, the softening of the data, but also some of these kind of core inflation components that, are not really going down? I mean, decelerating to the upside still is, the way we should describe these things, right?
No question about it. That's definitionally what disinflation is. But you're right. I think one of the reasons why things like consumer sentiment have been dented is because the real consumer, the average person out there, Main Street, thinks of inflation in level terms, not the minutia of month over month changes in core services X housing type metrics. That's what us market watchers and Fed watchers and wonks look at. It's also, I think, the reason why there seems to be this disconnect with milder inflation, meaning disinflation, and the way the society thinks about it is if you break inflation metrics, CPI as a for instance, into the non-discretionary versus discretionary components, those non-discretionary components, things like auto insurance, which continue to skyrocket. The needs, what we spend on, that we have to spend on, that type of inflation is more in the 6% plus range year over year, versus the discretionary categories are closer to flat. And I think that's one of the reasons why, even though we're still in this mode of disinflation, the sentiment around inflation by the public is quite a bit different than what you would pick up just looking at charts.
And for the stock market, Liz Ann, did earnings just show enough power through these sticky inflation metrics, or is it still pinching companies? And does that mean we'll have a concentrated stock market still like we did in the kind of first couple months of the year?
Yeah, I do think there's going to be some concentration, more of a quality concentration, and specific to earnings, protection of profit margins. What we did see throughout earnings season is, even though at the bottom line level, meaning earnings, we saw a better than average beat rate, a better than average percent by which companies beat, decent support for profit margins. The top line, similar numbers, the beat rate, the percent by which companies beat, were actually pretty comfortably below average. So you are seeing that shift down in inflation bring down that top line growth, really exposing who actually has pricing power and where the ability to raise prices was just in line with inflation. So I think we're certainly seeing that get weeded out in earnings season. It's reflected in how stocks have performed. Even double beats, meaning you beat on top line and bottom line, the reward accrued to those stocks in the immediate aftermath of earnings has not been as significant as the punishment accrued to companies that either miss bottom line or have a double miss of bottom line and top line. So I think there's a lot of bifurcation going on. It's happening in the economy with discretionary versus non-discretionary, with high-income consumers to low end, with larger companies versus smaller companies. And that's manifesting itself still within the market. Profitability, high interest coverage, exposure to moves up and down in interest rates. Those have been the stocks that have performed better.
And we've talked many times before about how the kind of shorthand way to think about this has been the small cap universe, just on an index level, a broad index level. The Russell's limitations kind of seems like then you would believe, Liz Ann, we might still be kind of limited in the participation for those lower quality groups. Fair to say?
Yeah, notwithstanding the pops that we've seen in some of the meme stocks, which, that's just not even worth having a conversation about. I think you do still want to stay up in quality down the cap spectrum and avoid the zombie type companies, the non-profitable companies. And Oliver, that's why you and I have talked about this before. I think not as a recommendation of an index to buy or not buy, but just as an FYI, the S&P 600 version of small caps has a profitability filter. So there's less of that denominator problem that you find with the Russell 2000, which does not have a profitability filter. And you've got more than 40% of the Russell is some combination of non-profitable and zombie company, and the percentages within the S&P 600 are much lower there. And that's one of the reasons why you have about any given day, 9 or 10 multiple point difference between the forward PE on the Russell versus the forward PE on the 600, because you've got that healthier denominator.
Speaking of profitability, Liz Ann, the last point on valuations. I mean, we still have a couple big names, namely, of course, NVIDIA, highly concentrated, so that's going to be a meaningful impact on the market valuation. And but generally, valuation-wise, how much have we frothed up?
Well, valuations are rich. They've been rich for a while. Valuation should never be a market timing tool. There's no consistent and accurate market timing tool, but I certainly wouldn't put valuation anywhere near a list of those that in the past have had pretty good signaling. What we had last year was all multiple expansion because we had very little earnings growth. This year, when we had the pullback phase, it was all multiple contraction because we've got positive earnings growth this year. I do think we're still in an environment where earnings need to play some catch up to the multiple expansion. I'd also point out, you mentioned NVIDIA, but speaking more broadly about the Magnificent Seven, fourth quarter last year was ostensibly the peak in the growth rate for that collection of stocks at about 60%. And that was at a time where S&P earnings for the other stocks, the other 493, was in low single digits. That's expected to converge by the third quarter of this year, where you look at both the Magnificent Seven and the rest of the market around the 13 to 15% earnings growth. So that's just something to be mindful of in terms of where the expectations bar has been set. Be careful about extrapolating the latter part of last year's huge year-over-year gains in earnings for some of those mega cap names. Just be careful about extrapolating that too far into the future.
Okay, understood. Good stuff. Liz Ann, great to catch up. Thank you very much for your time. Liz Ann Sonders, Chief Investment Strategist at Charles Schwab. All right, good stuff.